Hi, and welcome to Mortgage and Financial Solutions. I'm your host, Mark Rigney. On today's program, we're going to tell you about a tax-deferred exchange in the real estate industry. A tax-deferred exchange, also known as a 1031 or Starker exchange, makes it possible for investors to sell and buy property of like kind while deferring the tax consequences. A successful 1031 exchange allows the investor to reinvest 100% of the equity from the sale of a property into a purchase of a preferred replacement property. If you or someone you know is buying and selling investment properties, then pay close attention to today's show. In our studio today is Charles Sullivan. Charles is a real estate agent and expert when it comes to tax-deferred exchanges. Hi, Charles, and thanks for being here. We're excited to have you.
Thank you, Mark.
Charles, why don't you start by sharing with our viewers a little bit about your professional background?
I am a consultant with RE/MAX. I've been in real estate for the last 12 years. Previously, I had worked for Fortune 500 companies, and I've also owned my own businesses.
Okay, so clarify, what is a 1031 or Starker exchange?
It's a tax mechanism whereby an investor can sell a property and not pay capital gains at the time of sale, but instead invest those gains into another property.
But this is strictly for the investment property. A primary residence, you cannot do this, correct?
It's possible to do it with a primary residence, but it's very, very rare, and I'll go over those circumstances a little later in the show.
Okay. Who was Starker? You hear Starker all the time, 1031. Who was Starker?
A lot of people think he was a congressman or a senator. He was neither. He was a landowner in Tennessee, and back in the 1950s, he and his son Bruce had some timberland that they wanted to sell to Crown Zellerbach. And one of the problems they had was they wanted to be compensated for the future value of those timberlands because timberlands generate income over time.
Okay.
T.J. Starker and his son Bruce took the IRS to court, and I think there were a number of trials, and our current Starker exchange, or 1031 tax-deferred exchange, dates back to these court decisions in the 1950s.
That's some time ago. Okay, so who exactly would want to use a 1031 or Starker exchange?
An investor that has a large capital gain in a property that he or she wants to sell and does not necessarily need the equity. They would turn around and select another property, and they could essentially defer their capital gains indefinitely.
You said large refund. How much? 10,000, $250,000, $500,000? What are you thinking about here?
I would think that most 1031 exchangers would probably not want to do it unless the amount of money they were attempting to defer, or excuse me, the amount of tax that they were attempting to defer was at least $20,000, $30,000, $40,000, which would suggest a gain of maybe $50,000, $100,000, $200,000, $500,000.
So for the investor who's going to make $5,000 or $10,000, you wouldn't recommend this product?
It's probably not worth the expense and the effort and the restrictions that are placed on you by the Internal Revenue Service.
Can a seller trade one property as opposed to selling it? Can a seller trade one property for another?
Theoretically, yes, although this almost never happens. If you think about it, everybody wants choice. The seller who's relinquishing a property would like to be able to pick anything in the investment universe. His partner, the person on the other end, the seller of the property he's buying, has the same notion. So there's a mechanism whereby everything is converted to cash, and that's how the exchange takes place.
A lot cleaner to do it that way than to just do a straight-up trade, I imagine.
Very much so.
Okay, okay. Can a homeowner of a primary residence, you mentioned earlier, can a homeowner of a primary residence utilize this 1031 or Starker exchange?
They can, but they probably would not want to, except in very rare circumstances. The reason being is that IRS Section 121 allows a homeowner who's occupied a property for at least 2 of the last 5 years to defer up to $500,000 of capital gain if they're married, or $250,000 if they're single.
Okay.
Now, the Starker could be used under certain circumstances, and the way that it seems to make sense to me is that a homeowner has lived in a property for at least 2 of the last 5 years, then moves out and converts their primary residence into an investment property. At the time that they sell the investment property, they could then use the 1031 to shelter any gain in excess of the $500,000 or the $250,000 that they were already getting with the 121 program.
What if they've already used that capital gains benefit? What if it's a single person and they've already got their $250,000? Can they use the Starker exchange in that situation?
They can do a 121 every 2 years.
Every 2 years?
That's correct.
Okay, so 2 of the past 5 years you have to be in the property, and you can only do it every 2 years. Is that what you're saying?
That's correct.
Okay, okay. Okay, so tell us the mechanics. How does the 1030 exchange work?
Very simple.
Use me as an example.
All right, let's say that you have some investment properties. You want to sell one of them. You put the property on the market. A buyer shows up. Within 45 days of the time that you go to settlement on the property that you're selling, and it could be 45 days before settlement or 45 days after, you have to designate 1, 2, or 3 replacement properties.
You don't have to buy them at that point. You just have to designate?
Designate them.
Okay.
Your election has to be in writing.
Okay.
Once you have done that and you go to settlement on the first property, the proceeds from that settlement, that is all the cash left over after the mortgage and other expenses have been paid, would then be deposited with a qualified intermediary. Okay, at that point you then go out and acquire the second property. And if you acquire the second property, that is go to settlement within 180 days from the time that you went to settlement on the first property, and you have not taken possession of the cash, then there is no capital gain. That is, you've deferred it. You've successfully executed a Section 1031 Starker exchange.
If you say don't take possession of the cash, who does have possession? Where is the cash at? Can it be in your bank account? How is that part handled?
There are a small number of firms in the United States that specialize in acting as third-party intermediaries.
Do you have to use one of those firms?
You do not.
Can you use a title company?
Yes, you can, although most title companies find the restrictions are so tight that they do not want to do this.
They don't want to get involved.
It's more trouble than it's worth to them. The IRS has very, very tight guidelines, and only the specialists are the ones that seem to want to play this game.
So they don't receive much compensation, and it's more headaches for them than it's worth. Is that what you're saying?
Exactly. For somebody selling a single residential property, they might expect to pay the third-party administrator anywhere from, say, $750 to $1,000 as a one-time fee.
I mentioned in my monologue that it has to be a like-kind property. Emphasize that for us. What does that mean? Does it have to be a condo to condo, townhouse to townhouse, single family to single family, or is it monetary? 250,000, 250,000. Explain that for our viewers, if you would.
Glad to. Like-kind exchange means any real estate that's held for investment purposes. It could be a condo, it could be a timeshare at the beach, it could be vacant land, it could be a shopping center. The only restriction is, there are 2 restrictions actually. Number 1, it must be located in the United States, and number 2, it cannot become the investor's primary residence. It has to be held for investment purposes. Now, the other thing is that it's going to have to cost at least the amount of money that is being deferred from the first sale. So let's say that you had, just hypothetically, a $250,000 profit from the first sale. Well, the purchase price of the second property would have to be greater than the amount that you're deferring. The whole trick is that you as the investor do not want to take physical possession of the cash, because as soon as that occurs, you've created a taxable event.
And it doesn't necessarily have to be a residence. As you said earlier, it could be raw land. It could be some other form of land.
Absolutely. The IRS defines like-kind property as any property held for investment purposes. So if you were selling a rental house, you could buy another rental house, or you could buy a shopping center, or you could speculate in land, any number of different options.
What if you moved out and you weren't able to rent the property? Could you still use that, even though it's, I guess, would that be considered an investment still if you don't have a tenant in the property?
I believe that the intent of the law is that you make a legitimate effort to rent the property out. That is, that you try to find a tenant. Some of these questions, I think, would be best answered by a tax advisor. And one of the things I would tell viewers is that always check with your tax advisor first in putting together a 1031 exchange.
What does the seller do at the point where he identifies a new property? What happens there?
Well, remember, the first time the seller identifies the property is within 45 days of settlement. Now, when he or she goes out and finds the second property, they are going to have to do two things. Number one, go to settlement within 180 days, and number two, notify the third-party intermediary to send the funds to the second title company.
So two title companies have to be involved here?
That's correct.
Okay.
There's the one that handles the first sale, and then the one that handles the second sale.
You can't use the same title company for both transactions?
You could. You could. The key here...
And can your intermediary be in that same title company, the gentleman that holds the cash, the trustee, if you will?
Possibly, although most third-party intermediaries do not do settlements.
Okay, okay. Well, explain what you mean by a third party holding the proceeds from the sale.
Okay. Normally, if somebody sells a property for a profit, the title company handling the sale will pay off all liens and obligations. That would be mortgages, transfer taxes, and other fees, and would then give the seller a check for anything left over. Under a 1031, no check is created because the money is immediately transferred from the first settlement company to the third-party intermediary. So that way that the seller never has constructive possession of the cash.
Charles, is the seller of the second property affected by the transaction at all?
Not at all. They might know that it's a 1031 exchange, but they're still going to get paid just the way they would normally as if a bank were making a mortgage loan on the property.
So there's no legal or tax ramifications for him whatsoever?
Not for the seller of the second property, no.
Okay. Clarify who can be the third-party intermediary. Can it be a relative, a blood relative, uncle, aunt, mother? Does it have to be a title company or an attorney? Elaborate on that for us.
Be glad to. Third-party administration is typically handled by a law firm that has a specialty in real estate and specifically a subspecialty in handling these transactions. The rules and regulations are so complex that, as I said earlier, most title companies do not want to serve in the role of third-party administration. Could it be an individual? Yes. But it's normally, as I said, a firm that specializes in this and makes sure that the investor stays in compliance. Because if one of the two deadlines is missed, either the 45-day deadline or the 180-day deadline is missed, or the election has not been made properly, that is that the investor did not complete the correct paperwork to identify the replacement properties, the IRS will unravel the transaction. And it's as if there had been no 1031 election at all, which means that the capital gain is going to become due at the time that the first property is sold.
So is it safe to say that the third-party intermediary will be compensated for their holding the funds, acting as the trustee in the situation?
Yes.
And if so, how much? What's the percentage? What can a seller who's doing a like-kind exchange expect to have to pay a third-party intermediary?
Normally $750 to $1,000 for a simple transaction. Okay. That's about what it costs.
Okay, okay. What happens if the replacement property is not identified within the 180-day time limit?
Now, the replacement property has to be identified 45 days before or after the first settlement. Again, if that requirement is not met, then the IRS will unravel the transaction.
And did you say that you can buy the replacement property before you sell the investment property? That can be done?
It can be done, and that's called, as you would expect, a reverse starker.
A reverse starker.
It's a much more complex transaction.
Explain that for our viewers a little bit. What is a reverse starker?
Once in a while, an investor may see such a great deal on a property that he or